All right, everybody, what's going on? Today is Thursday, January 19th, another down day in the market. I suspect that today was another drain. Yesterday was actually a good day as far as the fiscal flows were concerned. We had like a 24 or 22 billion net positive flow. We had like a 40 something billion leading flow. But of course, you know, yesterday was boosted by the Social Security payment, and unfortunately, you know, it didn't really do much yesterday. The market was down a lot, but because that's due to the fact that the previous 2 days we had those huge tax drain of almost 70 billion. So we recovered like 21 or 22 billion of that yesterday. Which put the deficit for the month at like 72 billion. That's not bad, by the way, given, you know, that we're having these tax drains. The other thing is, like, when I look at where we are in the month in terms of spending, we're up like 17% over December. So, and I think I talked about this yesterday, and it is something that I predicted back at the end of 2022. I said when we get into 2023, we're going to see a significant increase in the fiscal flows, and that's actually happening. And if you want to pin me down as to what I think, you know, the big macro outlook is, again, you know, I go back to the swimming pool analogy. The flow, if you think of that pipe filling up the pool, the flow rate into the pool has increased by 17% over last year, at least so far. And that's a good thing. It's not a bad thing. And like I said yesterday, we can get real tunnel vision about day-to-day market action and headlines. I mean, that's easy. And that is just human nature, you know. It's hard to step back. And it's hard to keep the big picture and perspective in your mind, especially because we are overloaded with information all day long with the internet and television and everything else. We are overloaded and bombarded with information. And unfortunately, a lot of that information is either wrong or it's sensationalized. I mean, they do that on purpose to try to get viewers or readers or whatever. I'll give you an example. I mean, this, and I think I've mentioned this in the past in some of my videos. When I was working at Fox News as a contributor, and I left there in 2012 or 2013, I forgot, but I was there for 10 years as a contributor. There were times I remember, like, the producers used to send us the topics that we were going to discuss on these panel shows, you know, and they would say, you know, send us, oh, we're going to talk about this, this, and that, and, you know, maybe throw in a little numbers or figures we want to focus on. And sometimes I would find like the data would be completely wrong. Like it's just the actual data, which I knew because that's what I do as an economist. You know, I track all this stuff. It was wrong. And I'd write back to the producer, I'd email back and I'd say, like, you know, hey, Gary, this is actually wrong. And they would say, it doesn't matter. This is the way we want to present it. So I'm only giving you this picture to make you understand that television, it's all about ratings. It's all about ratings. It's not about really digging down and getting the truth. And we know that ratings spike when the headlines are sensational. Fear is a big motivator. I mean, when we get scared or we hear something scary, what do? We run to the TV or we run to the internet, we Google stuff. So that's the way it's presented all the time. And the same thing on the upside. I'm not trying to be biased one way or another. Like when things are going well and when the stock market is booming, you know, you'll have sensational headlines all over the place about how, you know, it's just going to keep going up and it's great and this and that and blah, blah, blah. And so you have to be very wary of these things, and you have to have some guidepost I talked yesterday. I think I talked about the navigator, the sailor out on the open. You have to know where you're going. I need to be able to look at, if not one, maybe a couple of key elements that, I've called them in the past my core analysis. And those are these flows. And I chart them. I mean, it's graphic. I could see not only the numbers, I could see a visual picture of these things. And when they're increasing, I have to go with the data. I just have to go with the data. And the rest of what's going on, if it goes against what the data is saying, that's just noise. I just treat that as noise, So the last couple of days with these with the market sell-off, I can understand that, in the short-term perspective, because those were tax drains. And I think a lot of you now understand, because you've been following me for a length of time, you see the correlation. I mean, and I've said so many times in the past that these things are tradable. I mean, if you're a short-term trader, and if you're trading futures or options and you want to take advantage of these things, they're there to take advantage of. I mean, there's a reason why there's an old saying on Wall Street, sell in May and walk away. Is because in April there's a huge, gigantic tax drain that leaves everybody's balances like way, way down. We saw that last year, and it takes, a couple of months, or at least a month or 6 weeks at least, for those balances to be replenished. So there's logic to all this. There's numbers behind all this. It's predictable. And then you have policy, when Congress does its budget, if there are spending increases, you factor that in. That's a positive environment. If there's spending cuts, that's a negative environment. The thing we have to worry about, and I've been saying this since the beginning of the year, and I've been saying it since Kevin McCarthy got elected Speaker, is the position of the fiscal hawks in the House of Representatives. And we know that the debt ceiling is probably not going to get increased. It's only going to get increased right now if there are going to be spending cuts that the Democrats in the Senate will cave into it. And that doesn't look like it's going to happen, at least right now. I don't know. Yellen has said, or Treasury, I don't remember where it came from exactly, but I think it was kind of an official statement that they're going to be okay through June, mid-June or the end of June or something like that. After that, I have to say it gets a little dicey, and I know that late last year, I was saying there's 0% chance of a recession. But then I had to qualify that a little bit, because if they do make cuts based on this political impasse with respect to the debt ceiling, then all bets are off the table. I mean, things can develop which change the picture. But for now, again, I'm just going to go back to what I said earlier. I see these flows increasing, and they're increasing nicely, up 17% month over month. That's the water coming out of the pipe. That's a very significant increase in the flow rate. So I'm not that worried. I mean, the numbers tell me you got to buy into this dip. We should get a recovery off of this, and then, once we get closer to the end of June or into June, that could be another story where we have to make another assessment. So, and again, that's something we don't know right now. I mean, politically, they could end up with an agreement. The Democrats and the Republicans could end up with an agreement. The Fed is not going to let defaulted bonds default. There was a comment made by former New York Fed President Bill Dudley, kind of alluding to the fact that the Fed is going to be there to support the market, which means they would buy the defaulted bonds. So, I mean, that default in terms of making good, and of course you knew that the Fed would do that over anything. The Fed would do that over, making sure Social Security checks clear, or anything. Because why? Because that's Wall Street's money. And that takes precedent over everybody, unfortunately. But that's the power of Wall Street in Washington. We all know this. We all know this. And today there was a lot of this ridiculous rhetoric continuing to fly around about, how the government, it's got to balance its books, and conflating it with a household. Like I said yesterday with this doofus Kevin McCarthy, today was Marjorie Taylor Greene and others who were saying the same thing. I mean, this again, like I said, it's mind-blowing to me that this narrative still exists. I mean, it's really, really incredible. But unfortunately, it does. And I think it's just as deeply embedded in people's heads and in, the people in Congress, and probably the president for that matter, as anybody else. Like, you don't hear anybody in Washington say, well, you know something? That's not actually how it works. There was somebody in Congress, I don't remember last year or the year before, who was pretty versed on MMT. He was not a well-known congressman, but he did, he was the one who, and I saw him on several interviews saying, that's not how it works. He basically was, he was explaining the MMT understanding that, you're a sovereign currency issuer. It's not the same as a household. There's no constraint on its ability to spend other than a political constraint that's self-imposed. Understand that this debt ceiling thing, which is totally ridiculous, is a self-imposed constraint, and it's an anachronism. As I've said many times, it dates back to the days of the gold standard, pre-FDR, pre-1933. We shouldn't have it. And by the same token, there's no need for the government to sell anything other than 30-day bills, because all the sale of government securities is a reserve drain. That's it. It works in tandem with the Fed as a policy setting mechanism for interest rates. So, why do we sell 2-year, 5-year, 10-year, 30-year? And then what you've seen over the past couple of years, there's been suggestions floated that, we should sell 100-year bonds. We should lock in the rate. I remember Jim Cramer, talking about that. This is is some family trying to lock in the rate on a mortgage. It's just not the same thing. It's apples and oranges. We should lock in the rate. 100-year bond. I mean, it's silly. It's totally silly. It's totally ridiculous. But yet, it goes on and on and on to the point where, I don't know about you, but me, I'm sick of it. I'm totally sick of it. And I hope, we get to the point where everything goes up against the wall. And let's make it happen. Man, who knows? Maybe, what a little bit reminds me of the downgrade in the U.S. credit rating. That happened in 2011 or 2012, I forget. But for years and years and years, there was always this speculation about, oh my God, what would ever happen if the U.S. debt rating was downgraded? And I kept saying nothing would happen. I mean, there's no putting a debt rating on a country that issues its own currency and where all its liabilities are denominated in its own currency is totally ludicrous. And years before the downgrade, and I did a lot of television, I said, there's gonna come a day, mind you, I'm telling you right now, there's gonna come a day when these idiots at Standard & Poor's or Moody's or wherever, they're going to downgrade the U.S. debt, and nothing is going to happen. And then it finally happened in 2011, and on the day that happened, and I remember the market was down pretty big for the day, I said, buy bonds. And I don't remember what the exact yield was at that time. You could probably go look it up. What was the year on a 10-year? What was the yield on a 10-year back in like 2011 when that happened? And yields just plummeted. They went down. Bonds went up. Nothing happened. It was crickets. Crickets. And I said that was going to happen years before it did. I said, mark my words. The other thing I said that was going to happen years before was like the U.S. dollar may eventually lose, it will eventually lose its reserve status, but not because of anything having to do with printing too much money and all this nonsense. It's because we're going to enact policies ourselves that will make it harder and harder for, or more and more risky for the rest of the world to hold dollars. And that's exactly what we see playing out right now. But the irony of this is that, the only way the rest of the world can truly rid themselves of dollars, as I've said in the past, is to exchange those dollars for goods and services or capital here in the United States. And we see that happening too. So that's not necessarily bearish for the dollar. However, I will end on this note. I think that if we get to a point where the Fed starts buying defaulted bonds, you will hear all these, monetarist, gold bug, inflationista zombies go absolutely insane. And you'll see the dollar really get hit. You'll see gold really go up. This is gonna, it'll play out this way. I don't even know if that's a correct reaction, but I'm certain it'll play out this way because everybody's going to be screaming like, that's it, we're Japan now. So I just gave you a really good trading opportunity to make big money, by the way, because if it gets out there that the Fed is buying defaulted, U.S. government treasuries, then mortgage your house and sell the dollar, and buy gold. And kind of like what we see in the markets happening right now, what's playing out, because gold is creeping up and the dollar is going down. It's almost like, this is starting to gain a little bit of a snowball effect. Like maybe some people are already starting to sniff this out. So keep your eye on this. It could be very, very interesting and fun and lucrative. Anyway, that's it for today, folks. See you tomorrow. Bye.